Oh my gosh. The names that I have been called in the
Oh my
last
God.
month
What is wrong with these people?
in this ripping rally. I can't even begin. This is not for podcast. Can I just read you something that I got?
Hang on, let me pause the recording because our editor's instructed not to edit anything.
Shit, we missed all that. That
Yeah,
was
that
golden.
she said it's not for podcast.
I know, and we respect Cameron, but that
off the
was
record
golden.
has to be respected.
Okay, good. That was all off the record. You people missed it. Welcome to the Futures Edge podcast. I'm Demurio, as always, the brains behind the operation, Bob Iacchino, and one of our favorite guests, a third time here, Cameron Dawson. What's your title again, Cameron?
I'm the Chief Investment Officer at New Edge Wealth.
Damn straight you are, and a good one.
Yeah.
You're one of the funnest people to talk to. Thank you so much for coming back.
Thank you for having me.
We had the CPI today. Bobby and I have been arguing a long time. I thought inflation was going away. I think inflation has gone away for the most part, and I don't even think we felt the effects necessarily of the rate hikes. What are your thoughts on this?
Yeah, I think that it gets back to, I remember, one of the first things that the three of us talked about back a year ago is the question of how much of this inflation did the Fed actually cause? And then how much of this inflation would be solved by the Fed's actions versus just time, meaning that if you look at the source of all the big upside to inflation that we had in 2021 and 2022, of course, it was related to supply chains and all the disruptions from the pandemic. And you could see it within the durable goods inflation and also basic goods inflation as well, because that included things like energy prices, which were disrupted from the war in Ukraine. And when we look at that source of disinflation, which really started all the way at the beginning of 2022, that's when that inflation peaked. We've now gotten to the point where a lot of the supply chain, a lot of the bullwhip effects of the aftermath of the pandemic have been solved. And those are just things that are solved by time. They're not necessarily solved by tightening down on liquidity. They certainly haven't been solved by a big dampening of demand. That's really what's interesting, is that you've seen demand for a lot of these goods remain rather resilient, despite the fact that there's higher interest rates. Look at how strong housing is. Look at how strong car demand continues to be, even with higher interest rates. And so the disinflation has really come just from the solving of the supply chains, which again is a factor of time. Now, of course, what we do know is that in the process of the inflation of the supply chain issues, because the Fed stayed on the sidelines for so long, and there was a liquidity aspect to this and a wealth effect aspect to the inflation, that's where we're starting to see that bleed out, where there's still these sticky portions of inflation that continue. And of course, the optimism from today's report is that, well, if you just take shelter out, then it all is not so bad. But even if you do that, it's not consistent with the Fed hitting its 2% goal. So I think that this is enough for the Fed to certainly pause at the June meeting, which is happening very soon, or might even be behind us by the time this is released.
It will be.
It will be.
Yeah.
And then keep July possibly on the table. But of course, that gives another month for a potential downside surprise. And so you could see this be, we'll see the dot plot and see where we shake out. You could see this be near, of course, the end of the hiking cycle. No surprise there. But I don't think that this disinflation we've seen thus far is enough for the Fed to be cutting and to be easing policy, because the last point here is getting back to that demand, which is that demand has remained very resilient. And even with the higher interest rates, so the question is, if the Fed were to ease policy, were to add liquidity, were to cut interest rates, would you end up stoking demand? And could that exacerbate or reignite some of the inflationary drivers, cause you to see some of this inflation start to come back if they're starting to add liquidity into what would be an economy that would be at full employment and also very strong? So I think it's enough for a pause. It might be enough for a hold and end, but it's likely not enough for a cut.
So Cameron, if I could, tell me where I'm nuts about this. So Jimmy mentioned that we've been arguing. And one of the things that I've argued is not that inflation wouldn't come down from where it was, but more so that we would have inflation at levels that they were uncomfortable with, they being the Fed. I liken it to, if I'm comfortable at 180 pounds and I shot up to 600 and now I'm back at 360, which is basically what happened with inflation. Am I now comfortable at 360? We just had 5.3% core CPI, headline PC or core PCE somewhere upwards of 4% or at 4%. And this is the thing that keeps me thinking with 3.7% unemployment. Chicago Fed says full employment is 4.1. Okay. And 4% inflation. Where do we get these cuts that everybody's talking about? And to add to that, anyone who believes there's no recession coming and the Fed is going to cut rates based on no recession, I don't see a scenario where equities are just, let me throw this out. They can still go up. But in my experience, in my view, I don't see a circumstance where either we have stagflation or we have a recession or we have continued inflation. And I don't see any other way around that. Where am I nuts?
It's sort of, today's equity market is a bit like Freddie Mercury singing the song, I want it all and I want it now. Meaning that I want to have all of the earnings growth from a soft landing. And I want to have all of the Fed support through valuation multiples of a supportive Fed. And this has been that second part where we've been the most wrong this year. And it's been the thing that has surprised me the most, which is that if I look at the source of all the returns this year from the S&P 500 basis, it's all completely come from valuation multiple expansion. And that is not what we expected, because our base case was that growth would be stronger than expected. Inflation would remain stickier than expected. That would cause the Fed to remain tighter than expected, which would push up interest rates, mostly real interest rates, and thus result in downward pressure on valuations, or kind of a continued kind of lid on valuations. I was just pulling up the NASDAQ composite, which should be the most sensitive to interest rates and liquidity and all these things. And it's now trading back at the same levels it was trading in November of 2021. And so where I'm still cognitively working out is, where could this source of valuation multiple expansion be to get you back to what, in my view, were bubble multiples during that time. And there's a few reasons for it. You could say it's because markets are underpricing within the earnings line, the potential for AI, the potential for a CapEx boom, the potential for productivity, all of those things. And so the multiples aren't going to look as stretched as they are today because you'll just grow into them. Essentially what happened in 2022, earnings didn't really collapse in 22. We just grew into the multiples, but
Right.
The multiples fell a lot more than the earnings did, and thus the stocks fell. So the other aspect to it is that liquidity actually has been supportive. We've talked a lot about how you've actually seen a huge flood of liquidity into markets internationally from Japan's yield curve control, bond buying, and the Japanese balance sheet now back at an all-time high. The fact of the Treasury General account spend down, where you had that effectively offsetting QT, and then the Fed's response to the regional banking issues also being a source of incremental liquidity, all wrapping up to saying that yes, even though the Fed's been tightening, liquidity has actually been becoming more abundant all through 2023, which can explain why valuations have expanded so much and why we've been wrong about the kind of makeup of the returns of markets, where we just did not expect valuations to be able to expand as much as they did with this kind of Fed backdrop. So maybe that dichotomy can persist forever, or maybe there will be some gravity that is applied if the Fed remains tighter for longer.
I think the dichotomy is what I'm pointing to, because I believe this is a dichotomy. In other words, and if I got the definition of dichotomy wrong. Make sure you tell this Italian idiot what it means. But I think we're in a circumstance currently that
It's a
can't
Latin language.
sustain.
This is probably
It's my second language. What are you
There's
going
a
to do?
root there. Come on.
It's my second language. What do you want from me? No, I mean, dichotomy to me means it needs to change. This is not the normal course. And I don't see a change that's positive overall. Sorry, Jimmy.
No, it's okay. I wanted to add, because there's a couple things you said. You said liquidity. So to me, is it as simple as, if we kept M2 money supply growth at the same pace that it was going since fall of 2011 and took out the fact that we just jammed 7 trillion into it all at once, we'd still, despite the fact that M2 has gone down 4.6%, we're still like $2.5 trillion more in the system than would have been. That's the liquidity you're talking about, right? So that's just, I see your head nod, yes. So now we talk about the Fed. Can you explain to people about the Fed spending money and not borrowing as much money since January and now having to reverse that?
Yeah, so I want to address the first thing, because this is an interesting one about effectively a stock versus flow argument. Because if you look at M2 money supply growth on a year-over-year basis, it's shrinking at the fastest pace ever on record, and typically that's really, really bad for asset prices, or asset valuations. It's not a good predictor of asset price returns, but the valuations themselves have typically been rather correlated. And so that would point to, or this would be another one of those dichotomies of how is this possible that we're seeing so much multiple expansion and yet this is still shrinking. And to your point, it's because you were coming off of such a huge surge that after you grew over 25%, shrinking 4% is not making much of a dent in the overall, which is why there's still so much buy the dip mentality. And why, it's interesting, taking it out of public markets into private markets. I was just speaking today with a bunch of private market folks in the alternative space, and people are clamoring to get into riskier assets. My phone rings constantly for distressed real estate. My phone rings constantly for private credit, private lending. And that's typically not consistent with an environment where everybody's sitting on their hands, nobody wants to lend to each other, and liquidity is really tight. And it still speaks to that after a decade and a half of quantitative easing, this is what we get. We get into a world where there's still so much liquidity sloshing around. So that's one aspect of the liquidity side of things, which is that the stock of liquidity may matter more than the flow of liquidity, and why there's so much buy the dip. The second question you had was around this dynamic of the Treasury and quantitative tightening. And this one, there's so much debate on this, and people will go, well, this is sort of, it's a dumb argument, it's a phantom argument, but roll with me here for a second. Which is that when the Treasury is spending its cash balance, it's issuing it's spending its cash balance, it's spending money, but it's not issuing bonds. And the activity of issuing bonds effectively drains liquidity or drains reserves from the banking system in various different ways. But when they just spend money and spend their cash, you don't have that offsetting factor of draining the liquidity. So what we've seen in the past 6 to, now 8 months or so is that as the Treasury hit the ceiling of the debt limit, it started spending down its cash balance, which has effectively added liquidity into markets because it's not issuing as many bonds as normal. So the question is, if you go back into the prior times where the Treasury spent its cash balance down, you saw big, huge periods of growth stock rallies. And so there's a pretty strong, tight correlation. Now, there may be no causation, and it could be just that it was a spurious thing that happened over the past couple Treasury general account cycles. However, it would help to explain why we've seen so much multiple expansion and growth stocks this year. Outside of the AI side of things is just that maybe there's that liquidity driver. And then of course, the question is, now that we're on the other side of the debt ceiling, as they start issuing more bonds, do you see that liquidity start to drain? The thing I would just add to this, and Dan Clifton is the one who's done great work on talking about these relationships. He's over at Strategas. And the interesting point is that in the first quarter, there was more liquidity added through TGA and the Fed's activities than at any quarter it was taken away in 2022. So it was $750 billion added in the first quarter of this year, and only $700 billion taken away in the second quarter of 22. Why is that important? 2Q 22 is when all the asset price losses happened. And so it's something that we consider. And it's so funny because now the narrative has been, well, we're past the debt ceiling and markets are still ripping. So this must not be a factor. This must not be important. I think it's still a very important watch item. It may not happen at the same pace and time as you would expect, but I do think it could be an important driver for markets in the second half.
Cameron, before I ask you this question, I thought "Don't Stop Me Now" was brilliant this past week in your note, using the Queen lyrics for the beginning of your note. And I wanted to ask you about this because I was listening to—
That was actually my colleague, Jay Peters, who wrote that note this weekend because I was on vacation. So
I read it and I'm like, that's beautiful. So can we speak to
brilliance goes to Jay.
Is it okay to speak to it? I'm sure you looked at it. I'm sure it's as much your research, if not more. From the perspective of— from the perspective, that was a weird backhanded compliment. From a perspective of market breadth, Richard Bernstein was talking about it this morning. And he just said that basically with 5 to 7 stocks driving the rally, he goes, I can't find a period of time where that was a good sign for the market. Now, it is possible for the breadth to widen out. And that's sort of what you guys were talking about in the early parts of this note, talking about 60% year to date, essentially for Apple, Microsoft, Amazon, and the rest for the S&P. Can it widen out, or does it have to sort of converge at a lower level in your opinion?
It's a really unsatisfying answer, but Jeff DeGraff at RenMac has done the work on this and trying to test this at different points of breadth. And what he finds is that about 60% of the time, it resolves positively. So the rest of the stocks catch up. And about 40% of the time it resolves negatively, meaning that you have the leaders start to catch down. The thing that jumps out to me, though, is that typically you don't see breadth declining so much at the start of a bull market. You do see breadth surge at the beginning of a bull coming out of the lows, mostly because if you're doing measures of breadth, things like percentage of names trading above their 50-day or 200-day moving average, it makes sense why you would see a big breadth surge because you had downward sloping moving averages and then everything starts to rebound. And so that's why you see these big spikes in breadth, and that they're typically a very bullish signal. And being overbought is typically a very bullish signal at the beginning of a bull market because it gives you, what the technicians will call thrust. It gives you this momentum and you might have to burn off some of this excess energy. You look at RSIs today being overbought. But it typically is good for forward returns, as ugly or as uncomfortable as it might feel in the near term. So it's sort of it could go either way. But what's different about this time is just how weak breadth has been, given how much we've come off the low and how much it deteriorated as markets kept moving higher through the month of May. Now, June has been a little bit different. It's broadened out some, but that's been the peculiar side to me, is that, I can get how breadth will just start to deteriorate some, initial surge, then you get the separation of the men from the boys. But this has not been just men from the boys. I mean, this is just like there's a few gods, and then everybody else, the rest of us are just mere mortals. And so I do think that it still is a valid market concern. But the answer empirically or historically is that it's kind of a split.
Okay, so at Monday, keeping with this theme, Monday of this week, I very vocally, Monday morning, I will add, put out a thing where what I wanted to do was short the Magnificent Seven against buying the Russell, under the thoughts that it's, one, that it was a crowded trade the other way, and two, that if the market was going to broaden out, I thought Russell was going to do a lot better. That trade worked pretty well, but I had to put it on by just shorting the NASDAQ and buying the Russell because I wanted to do it in futures, and I couldn't figure out a way to just tease out the 7. Do you like that trade, being that, and I'm not looking for an attaboy, I've taken 2/3 of it off already. My thinking was that those things were overbought, and if it broadens out, the Russell could outperform. Do you like
Yeah, it again gets to this question of, are we at the start of a big new bull market and liquidity cycle? We have seen plenty of bounces of things like the Russell that have typically been higher beta than the rest of the market in periods when markets have been strong. And this current bounce is kind of in line with what we saw in July of last year, as well as in January, where you saw a bounce off of kind of the doldrums, where Russell had really underperformed. And so the question is it sustainable? And that's where for us, we've remained underweight small caps for a while, because what you find is that the only times that small caps sustainably outperform is at the beginning of an easing cycle. And usually once the easing has been announced. So look at 2020 into 2021, you had the blow off of top of small caps at the beginning of 2021, but that huge, powerful rally coming out of the COVID lows was really because you had a bunch of near-death companies that got bailed out by support from liquidity. And if you go back in prior cycles, each time you had a re-engagement of Fed liquidity and Fed easing, that's when small caps led. And so what I'm trying to discern is that I agree with you today. They were oversold. They had been left out of the party. You see it broadening out. It's like a coiled spring. Of course, they can pop higher in a absolutely fantastic way. The question is, do you bank on it becoming something that's sustainable for the next 3 to 6 months? And for us, really the next 12 months in order for us to move into an overweight position. And that's where, because the Fed's not done, because we don't see the Fed cutting, we kind of look at it and go, well, maybe we're going to we'll keep our small cap exposure as staying high quality and probably not be ready to re-up it yet, simply because of that history of small caps not being great sustained outperformers, except for in periods at the beginning of easing cycles.
Which, by the way, that's why I took 2/3 of it off, just because to me it was the coiled spring thing that worked. But yeah, if the fundamentals don't support it long term. The next question is 2 parts. One, do you believe the Fed is currently on hold? Is the hiking cycle over? 2, if we were so lucky to have Cameron Dawson be chairman of the Fed, would we be neutral and on hold right now?
I love that question.
Thank you.
Well, I don't necessarily see the merit in skipping, in the sense that you don't really see any distinct signs today that the Fed's tightening is causing immediate issues with economic growth. Now, I'm going to answer your question by not answering your question. Just roll with me here for a second. I want to go on a tangent because it's been something I've been noodling on, and I'm curious of your response to this.
Have at it.
Which is that I mentioned, we have, a decade and a half of quantitative easing behind us, or 12 years of quantitative easing behind us. And the result of quantitative easing is very different than just cutting interest rates, because QE lowers interest rates across the curve. So when the Fed used to cut interest rates and stimulate policy, it would be in the front end of the curve. And of course, you might see the full curve start to shift down, just term premium, that type thing. But the real impact of QE is that you compressed long run interest rates. Now that has an interesting impact on markets, because of course you see it improve things like equity valuations, but in the real world, it allows people to term out their debt. And by people, I mean both corporations and consumers. And corporations, you can see it by looking at the usage of things like commercial paper, which has been very low, much lower than what it was at the peak in 2008 or in the peak going into the 2000s. Commercial paper being the shortest term paper that is used for, just short-term financing needs. But if companies can borrow instead at very low rates at 10, 30 years, why do you need commercial paper other than just working capital management? But you don't need to rely on short-term debt as much. At the same time, as if we look at consumers have been able to term out their debt through mortgages with the fixed rate mortgages and not having the kind of sensitivity to rising interest rates, simply because they've locked in a 30-year fixed at very low rates. And we went into 2022 with only about 7% of mortgages being floating rate. and compared to 35% at the peak in 2007. So I say all of this to lead up with, I would argue that big borrowers might be less sensitive to short-term interest rate increases because of 10 plus years of QE, because they were able to term out their debt. So Fed raises interest rates. Usually in a world where people are exposed to short-term interest rates, that could have the impact of slowing economic activity because money becomes more expensive. But if you're agnostic to those interest rates, or a big cohort of borrowers is more agnostic, then you only get the benefit of higher interest rates. And I'm using an extreme. Obviously, there's some borrowers who have floating rate exposure. But what I mean by the benefit of higher interest rates is higher cash rates, higher bond yields to savers. And so in some ways, there's been a stimulative effect of these higher interest rates because people have been able to earn money on their cash. At the same time as you have it happening where you have the stimulative effect of inflation and all the price index types of payments and entitlement payments. So I'm putting this all together to say, I don't know how much the Fed's tightening of policy has actually impacted the market or will impact the market in the next 3 to 6 months. And is that an argument for continuously raising interest rates? I don't know, but it is a good explanation, I think, as to why you've seen economic growth remain so resilient, despite the fact that we've had such a rapid tightening cycle.
So can
I'd
we
probably hike at this meeting if I was at the Fed.
Well, so, okay. So again, I want to point out to people, we're recording this before the meeting. Cameron's not predicting it. So matter of fact,
No, she said she would
Yeah,
hike.
she-
No,
no,
she
I know.
actually said before that the futures market, they're probably going to go along with that and not.
I just want to be clear about it so she doesn't get any weird emails or tweets about how she was wrong. She's not
We're gonna
predicting. As
get
a matter of
those,
fact,
so.
I think you exactly. I think you actually said they'll probably pause, which again, Barkin called it. No, not Barkin. Harker called it a skip, which is interesting because right now the CME Fed watch tool prices in no rate hike, 8.1% chance of a hike, which would be tomorrow because we're recording on Tuesday. So that'll be gone by the time this is released. And now it's pricing in hikes in July as the highest probability, which to your point, why skip if you're going to push rates higher anyway? I mean, what's the weight? Abby Joseph Cohen said this morning that based on all of her research, she says that her and the Fed don't understand how long it takes for their movement to actually hit the market and have an effect.
I would like to add too that they don't understand anything else either. But anyway, go on.
But anyway,
No,
like again,
don't.
if you think there's going to be no recession, well, I'm not saying you do, Jimmy. I'm just saying if someone thinks there's going to be no recession, they should just buy stocks because traditionally stocks don't bottom until the recession starts. So people are buying stocks right now, think there's no recession coming. They think the consumer's so strong. Then you think the Fed has engineered the first soft landing ever, except for that brief one in I think it was 90, 91. 94, thank you. And so like I maintain a great investment is gold because 2007 to 2009 recession, gold up 130 some odd percent. The tech bubble, gold up 25%. 1990, 91, gold up 10%. 73, 75, gold up 200%. Gold does well as we go into a recession. Then as the Fed cuts, it suffers, right? But right now, gold is not breaking out because everyone is assuming these cuts that I don't think are going to happen. There's a question in here, I promise. But you actually, it seemed
Well,
like you
I don't
would
think gold is
say
breaking
something.
out because look at economic surprises.
Mhm.
Look
Where
how
is it?
strong economic growth has been. And you see economic surprises flip massively positive starting in May,
Mhm.
showing you that economic growth is not falling off a cliff. And so it might be the right trade once you start seeing the real weakness. I mean, you saw gold surge during all the regional bank issues, but
Right.
because economic growth is holding in better than expected, it actually is showing up in yields too. You've seen real yields start to climb again as growth has been better than expected, where it's not been showing up as in equity valuations, which have typically been sensitive to things like real yields, but are not anymore right now.
So it's funny you say that because I'm looking at a gold contract that isn't collapsing in the face of all that. Now, that's not a good reason to stay in when I have a stop and I'll get out when my stop is hit. But I look at your note every week that I get it. And there's another one, Mike Singleton at Invictus Research. I look at his stuff a lot. I like following research people that are like half my age, but he has been pointing out manufacturing PMI and how rather than manufacturing PMI, and you have a history as an industrial analyst, right? So manufacturing PMI falling and services coming down toward that rather than the other way around. Do you see anything there?
Yeah, so I think the one thing is to note, PMIs are inherently soft data, it's survey data. And one of the things that you've seen is that industrial production has remained rather robust, even though the PMIs have fallen, which captures some of the recession anticipation that people have, and not necessarily the recession reality. We continue to see industrial production remain really resilient despite all this negative sentiment in manufacturing. The other side of things is that you're seeing some areas of fixed investment really surge. Part of this is because of the CHIPS Act and the Inflation Reduction Act. That there was.
You had a hard time getting that out, didn't you? Because it's not. But
yeah.
Go ahead.
Yeah, I tried. That there have been certain things in there that have been stimulative to CapEx. And so you're seeing it in fixed asset investment, fixed structures. So you can see it within non-residential investment, a real estate investment outside of things like offices. You can see it in the structures portion. That suggests that there is some kind of CapEx, maybe it's not a boom, but certainly big recovery. And Neil Dutta over at Renmac has made the point that, there's an opportunity for manufacturing to reaccelerate because inventories have been drawn down so much, and yet demand has remained resilient. And eventually you will have to catch up to demand with your inventories. Otherwise you're missing out on sales. And I think that's an interesting point because it also gets to this notion that everybody talks about, like, oh, this is the most anticipated recession ever, and it can't happen because it's so anticipated. Well, wouldn't it be interesting if just as people are starting to rebuild their inventories, that actually is the moment that you get caught flat-footed? Recessions happen when people have too much stuff and no one to sell it to. And right now, inventories have become pretty light, kind of in different pockets of the market, because you've seen this drawdown of inventories, that you're not really in that state. It doesn't mean that you can't have a financial system related recession, but just that kind of old classic cycle recession usually is when you're overextended. So I think that it's possible that you could actually see manufacturing recover. Does that mean that those related stocks will do great? No, not necessarily. They trade so many steps ahead, so many derivatives ahead. So I think you have to be aware of just where you are and kind of the pricing in of that cycle. But it's possible that PMIs start to rebound just because demand's remaining so resilient.
Okay, Cameron, I wrote a Substack a week and a half ago, and to compare my Substacks to the things you write, it's kind of like a caveman writing on a wall with a chisel, but whatever. One of the things I talked about in it, and I'm curious to get your opinion on it, is that back in the 80s, I think perhaps we're giving Paul Volcker too much credit for slaying the inflation dragon, because several things happened at the same time. One, kicking the door open to global trade, taking advantage of emerging market cheap labor. But the thing that I don't think gets mentioned enough is the internet and the technology boom that happened mid-80s on, I think was the biggest deflationary piece of technology that's ever been. It still exists today. I mean, it changes everything. It changed everything. Even retail spending, consumer goods, everything. The inflation is much more difficult. Is AI? Does it have as much a punch? Could that be the follow-through deflationary technology that affects us going forward?
You're asking an industrials analyst this, and I realize my bias is one of, like, I can't have nice things because every time some of my stocks would trend, we'd have a down cycle. So, so take what I'm saying, with a grain of salt. I think the question, it's less about the efficiency side of things for me that I find interesting from an equity market standpoint, because efficiency is one of those funny things where you have to ask who the benefits accrue to and where those benefits end up lying, because sometimes one person's efficiency is another person's loss. So it's not to say that it's a zero-sum game, but you have to be aware of where the efficiency is coming from. What I think is actually more interesting on the AI side of things and comparing it to the internet cycle is how much there will be a CapEx boom because of this. Because in my thinking, there was a huge CapEx portion of the internet boom, because you were connecting the world to the World Wide Web, which is not something that exists in like this nebulous cloud. It's fiber optic cable getting dug. It's everybody buying modems and PCs and monitors and mouse. There was a lot of spending that individuals, corporations, and the government did in order to make the internet something that was ubiquitous. And CapEx is something that it's not a zero-sum game. It's something that is actually a multiplier. And so I'm not arguing that like all efficiency, like it's dumb for me to say like zero-sum and efficiency in the same breath, because it's not, but you get what I'm saying in the sense that how much of this AI boom is going to be able to drive CapEx, and how big will that be on an inflation adjusted basis versus what we saw during the internet boom. And it's clear that it's going to impact and benefit NVIDIA, for example. Of course it is, because everybody needs their chips. It's clear that it will impact and benefit those that are building out the computing capacity and the big server farms for the cloud guys. Of course, it makes sense. But then from there, how much incremental spending is going to be needed? Is it hardware upgrades that we're going to have to do in order to be able to use AI to its full extent? Or will we be able to use AI and get the benefit from it from our existing hardware? Right now, I don't need a new phone to be able to do Chat GPT. However, maybe if the power of the technology ends up becoming so much larger, I might need more computing capacity. I don't know the answer to that. And I think that is the single biggest question of how big this trend could be.
But you didn't mention at all the potential for AI to eliminate jobs. Legal professionals, as Bobby talked about in our last podcast. Is it enough of a punch to take away so much of the labor force that it could, dampen demand?
Well, that's the zero-summy kind of nature of it. Now, we don't want to be was it the Luddites that, we're
no, of course not. Right. Yeah. The Luddites.
So,
right. Yeah.
Just as maybe accountants that were paper accountants lost their jobs, this is not frictionless, because it's one thing for us to say, oh, new jobs are created and by AI, and it kind of forgets the fact that real people will be displaced in this process, and it will cause real pain and retraining programs sound great on paper, but if you're living it, it's a very different story. I don't know what if it's going to be so big that we have to consider things like UBI, universal basic income. That's always been the thing that's been thrown out.
You gotta give me a sec after that. I know.
No, but that's always been, because that's like the logical, saying, okay, if technology is going to displace so many people and impact demand, do we need to come up with a way to be able to sustain demand? And so what I'm saying is, I don't know if the displacement is going to be so great to justify that kind of policy move. But it's still too early. And I don't know who the benefits of the AI technology necessarily accrue to, other than the infrastructure side of things. What is the business model of those that are creating the AI tools, and the people who are getting the efficiency? How is that being paid to the people who are providing the tools to get that efficiency? It's, obviously we went through this with software, and there were winners and losers of the people who benefit, the internet, people who benefited from the boom of the internet and those that didn't. It obviously ended up being a big, huge net positive. And I would say the benefit of the doubt is that it would be, but again, I'm an industrials analyst. I'm a cyclicals person. So, get some tech dreamer to come dream the dream with you.
Well, it's interesting to me. Jimmy mentioned that I mentioned it in our last podcast with Andrea Lamari. And the thing that I mentioned, the example I gave is I put together an easement for mine and my neighbor's property with AI. As opposed to I called an attorney, he didn't call me back. I called my regular guy, he was busy. And I'm like, I need this thing today because I'm putting up a fence. So I typed it into AI, gave a description, it gave me a perfectly usable legal document. I'm friends with my neighbor, it covers everything. I read it 14 times before I brought it over to him. He had no problem with it. And it got me to think that maybe the displacement is white collar for the first time of virtually any technology ever. And that surprised and scared me. I mean, I don't wear collars anymore, but it surprised me and scared me at the same time. It's like us we're talking about.
I used to cover the automation companies and the robotic companies. And there was all this talk about, about removing humans from manufacturing processes. And what you realized is that that's really difficult. Like something as simple as going in and picking the one white pin out of a bin of red pins and having a claw with all of the hand movement and everything in the sight. And, obviously I stopped covering them probably 4 years ago or so. So there's been improvements in that technology. I'm sure we're able to do that now. But what I'm saying is that the low-hanging fruit has never been labor-intensive manufacturing work at this point. There's still lots of room for automation. The automation companies are doing great. What my point is, the lowest hanging fruit is the white collar things that have not been automated to this point. And this really is the true disrupting factor in that. So I'm not going to push back on that notion.
And I do actually have a question, but I just wanted to add, I have a friend who works he's an engineer at one of the US automakers, but he started out on the line 20 years ago. And he's got these like giant Popeye forearms. And he said, automation, all it really changed was guys have smaller forearms. Well, he said it didn't displace that many people in the auto industry. Go ahead, Jim.
No, I was going to say Luke Roman was on the podcast a couple months back. And his quote that I will remember for a long time is that we are going to gravitate to a period where a plumber makes more than the partners at Goldman. And this speaks to what you just said too, both of you. It could be eliminating, white collar, eliminating people writing legal drafts. But I'll tell you, you mentioned UBI again, which I'm always going to be against, but I'm always willing to listen. There is a thirst for professionals in other places. The bar I own, we treat the tradesmen like gods because there's not enough of them. And when we need electricians and when we need plumbers, thank God they're sitting at the bar. So that I think it could be like a seismic shift. But I would like to go back to risk assets a little bit too. You had said at the beginning of the show that you missed some of this bull move. And you had talked about it before. I remember last time I spoke to you, it was about multiple expansion. You didn't see where it was going to come from. Are you still somewhat bearish, or do you think we could continue higher into the end of the year?
Okay, so I've been pushing back against this bearish label because
I said that's what you said. I'm not pointing anything at you. You're my hero. Go on.
Well, look, I get it because we've come out. I've come out and said, look, like stocks have been expensive, and I've been saying it. They keep getting more expensive, and so it's easy to say, okay, you're sitting on the sidelines. The first thing to note is how we approach equity investing, and it's that it's really important to stay invested. And that's what we've done. We have stayed invested. We're neutral equities. And the way that we've expressed some of our caution is really focusing on all weather parts of the portfolio and focusing on quality. And it's such a trite word at this point, but really focusing on those names that tend to defend capital better in the down cycle, meaning that they don't retrace all of the gains from the up cycle and the down cycle. And that worked really well for us in 2022 and at different portions of 23. But what we've seen this year is that it's not been the names that have the best free cash flow. There have been some leaders, look at the top 7 names are those that really are quality names. They might have extended valuations, but they're quality names. But you're also seeing things like lower quality parts of the market start to rip. So where we won't participate in that because it's outside of our long-term framework. I don't invest money to outperform on a 1-month basis. I'm not at a pod shop. So I'm investing for 1, 3, 5, 10, 30 years out in the future. So if we're then making a tactical call, the balance that I get is in the very short term, momentum's a positive. It's a really big positive, and it's powerful, and you don't want to fight it. It's one of those things where if you can't beat them, join them. And that's why you're seeing kind of capitulative flows into the market. You're seeing big, huge buying of tech names. You are seeing positioning now become, instead of being deeply, deeply underweight at the beginning of this year, to becoming about neutral. And now that we're at the neutral state of positioning, you've seen flows, you've seen sentiment start to rebound. The easy part is likely over. And now you've seen the valuation multiple expansion going from 15 and a half, 16 times up to almost 20 times, about 19 and a half times currently today. And so that kind of multiple expansion also gets you back into territory where stocks have typically peaked out outside of bubble periods, such as during COVID and during the tech bubble, if we're looking at next 12-month basis. So all of that would lead me to say is that in the very short term, fine, markets can rally because momentum, and that momentum surges tend to be good for forward returns. But then I'm very aware that is this the more that markets continue to press higher and diverge from the message of yields, or diverge from the message of things like oil prices making a 52-week low, that's where your bar gets increasingly high to surprise to the upside. We're not at the point yet where positioning is so long that it's a risk in and of itself. That's where we were at the beginning of 2022. So the exact opposite of the beginning of 23. But in my view, markets are expensive. Doesn't mean they can't get more expensive, but they are pricing in an easier policy path from the Fed that I personally don't think is going to materialize. And that what that leaves me is to say all my upside surprise has to come from earnings. So maybe there are companies out there that have the same kind of benefits that folks like NVIDIA do, but we haven't seen earnings estimates get revised up materially. They can on the back of economic surprises coming in better, but there already is a big ramp baked into the back half of 23. So, and into 24. So what I'd say is that, like, can they? Of course they can. Am I chasing it for for a 1 year forward return that I think is going to be really attractive compared to a 5% that I can get in a risk-free asset? Not necessarily, but I say all of that by saying, like, we are invested, and we're just invested in a way that we think is risk managed. We're not hiding out in uber defensives like utilities and staples, expecting the world to end. We own tech, we own industrials, but we're going to remain valuation disciplined because we're not here for 6 months. We're here for 12, 24 months. Is the exact opposite of, we're not here for a good time. We're here for a long time. All right. That's what we're doing. We're not here for a good time. We're here for a long time.
Thank you for saying that, because I think it's unwittingly, and not deliberately become a theme of the show, to be honest. We had Shanna Orzik on a couple of weeks ago. We're getting good at name dropping here, aren't we?
Yeah, how about it?
By the way, we drop your name a lot too, Cameron, just so you know when you're not on. And she said one of the easiest ways to not achieve your goals is to lose money. And I think people lose sight of what you just said, that the risk may be too high in exchange for a 1 year pop or a 6 month pop. And I think people need to understand that performance isn't just about performing to the upside. I think it's much more important to outperform to the downside. I really do. And I've said that for years and no one listened. And because we actually get people on the show that are smart, maybe they'll listen now if we keep getting them to say it.
Well,
I'm very used to talking to people smarter than me, you could tell.
The answer is not to hide under a rock. Right. And I think that it's very easy for people to be overly defensive all through up cycles, mostly because you have the PTSD of experiencing something like the Great Recession. You saw a lot of people, that creates the wall of worry, right? That by definition is the wall of worry when people are underinvested. What we're talking about is how can we be invested and be engaged in the upcycle of the market, knowing that over the long run, they go up about 80% of the time. But how can we make it so that way we can dampen the impact of the downside? And that's our quality solution. And are there times that that you should back up the truck and go into low quality names and say YOLO? Yeah, probably. But you have to realize that it's going to come with tax implications because your holding period's likely going to be short, and you have to be right twice.
All right, let's get towards the end here, but I would like to propose a wager to my two friends here. I will wager, will you take this bet for one shiny dollar, both of you? I will say that the Fed funds rate is never going to be higher than it is today anytime in the next 5 years. Are you jumping on the other side of that bet, Cam?
I'm in.
I will take
You're
that.
both in. I
Yeah.
figured you both would take that bet.
Yeah.
Anything else you
No.
guys want to hit before we go? Because I'm fading.
How do you plan to deliver the dollar to me, and can it be inflation adjusted?
It can be inflation adjusted, and I will deliver it to your doorstep. Right. No, we'll give us
I'd
another
like it in
reason to-
gold, please. Can I get it in gold?
Yes. How do you do a dollar?
$1
in
of gold now, so it might be like a point something ounce higher.
No, I just don't see it. I think that the pause skip thing is weird. Who skips?
is
I mean,
weird.
to me, it's
weird.
and again, if the Treasury starts taking money out of the system too, again, I'm not trying to talk my book here, because I know we got a lot of money riding on this, but here we go.
Well, we're
See
going to
where it
find out
gets into.
tomorrow. Watch the dot plot, right? Let's see.
What do they know?
Tomorrow.
What do they know? They're not Cameron Dawson. They are not. They don't know what they're going to do.
I think that the reason why they continue to hike all through the banking issues, right? That would have been enough for them in any other cycle inflation actually has not changed that much since the banking issues, right? Like we haven't, it's not as if we've seen this like meaningful downtick in a way that inflation is like suddenly gone, right? They already made up their mind before they said they saw this data. They wanted to get to their median dot to restore credibility. They wanted to say, we're going to do it. You got to believe us. And that means you should believe us in everything else we say. And I think that's why maybe this time around, you should listen to the dots, just because it is as much a pursuit of credibility as it is pursuit of a policy level.
Yeah, you've used that credibility word twice. I think that ship is so long sailed, is my opinion on that. Yeah, I know you do too. Yes.
Just
I'm just
because you can't get it doesn't mean you don't try, right? Like,
bingo. That's a great point. That's an excellent point. Yeah.
I had one more question, but that was so good. I'm done. I'm not even gonna
Okay. Thank you so much, Cameron. It's always so fun to talk to you.
Thank
I really
you.
appreciate it.
Cameron,
See you
can you
guys.
hang out 1 second?
Yeah.
Thanks.
So you can talk about me behind my back. I know how you guys operate. See ya.
Absolutely, that's correct. So, see you, Jimmy.